Welcome to February edition of Corporate ESG 5 and 5 podcast, the podcast in which we spend 5 minutes exploring the 5 key ESG trends set to shape the market this month. I'm Niceasia Mc Perry from Climate and ESG Capital Markets, and I will be taking you through this month's key trends. One of the recent important developments we have seen on the institutional side is the Sustainable Investor Group urging lawmakers to keep gas out of the EU taxonomy. In an open letter, the Institutional Investor Group on Climate Change called for gas to be excluded from the EU taxonomy green investment classification system, as it poses the risk of channeling capital towards inefficient or damaging activities to the environment. The letter pointed out that while natural gas may have a role to play as a bridge to support the transition to net zero, it does not meet the prescribed requirements to be classified as a transitional activity. When it comes to ESG disclosures, ICMA, the International Capital Market Association, warns that the proposed EU green bond rules would cause issuers to flee the sustainable debt market. The proposed EU green bond rules require extended fact sheets to be included into prospectuses, inclusion of EU taxonomy alignment plans, and mandatory external reviews for impact reports, among other requirements. ICMA stressed that this increased cost and potential liability for issuers could push issuers to turn to other markets and sources of finance, resulting in market contraction and loss of EU sustainable bond leadership. Within the sustainable primary capital markets, we have seen a few interesting transactions. Case in point, SNAM issued its inaugural sustainability-linked bond of its newly established sustainable finance framework. SNAM was one of the first and only firms to issue a transition use of proceeds bond, along with Cadent and Castle Peak Power in 2019 and 2020. Additionally, Places for People issued an inaugural sustainable bond in senior and secured format, which is quite rare, noting the fast bulk of issuance that we have seen in secured format. The framework is focused on affordable housing, green building, and energy efficiency, contributing to UN SDGs 1, 7, 11, and 13. Moving on to carbon markets, carbon offset prices could increase 50-fold by 2050, according to Bloomberg New Energy Finance. Prices for carbon offsets could be as high as $120 per ton or as low as $47 per ton in 2050, depending on the type of offsets available. Should all types of offsets continue to be permitted to hit net zero goals, the market will be oversupplied with largely worthless credits. Conversely, if the market is restricted to just offsets that remove, store, or sequester carbon to achieve net zero targets, there will be insufficient supply to keep up with the demand, causing significant near-term price hikes and damaging liquidity. Finally, when it comes to ESG investor news, AXA Investment Management has published a framework for assessing sustainability-linked bonds. Sustainability-linked bonds will not be part of AXA Investment Management green and impact investments, as opposed to green, social, and sustainability bonds, but rather as transition investments. Lastly, on the ESG investor news, Candriam has launched a new sustainable bond impact fund, which aims to reconcile financial returns alongside positive social and environmental impact. The fund aims to select corporate sovereigns and quasi-sovereign bonds based on their ability to address societal challenges and generate a positive contribution within the EU and SDG framework. Thanks for listening to this month's Corporate ESG 5 and 5. I hope you found it useful. As always, please be sure to check out our monthly newsletter linked in the description for more on the key ESG trends shaping the market this month. And if you like this episode, please follow the channel and click the notification bell so you can get future episodes as soon as they are released. Thanks again and see you next time.